You checked your portfolio this morning. The company you invested in just announced record profits, their best quarter in 5 years. You're feeling good. Then you refresh the screen. The stock is down 9%. You didn't misread it. The profits were real. The drop was real. Both happened at the same time. And nobody on the news is explaining why. By the end of this video, you'll understand exactly why this happens, why it happens constantly, and why understanding it will make you a smarter investor than most people who've been in the market for decades. Here's something that will change how you see every earnings report from this point forward. In 2022, Meta announced it had lost almost $3 billion in one quarter. Brutal, right? Their stock went up 23% the same day. Then in 2023, they announced record profits, billions more than expected. The stock jumped again. But here's what most people missed. In between those two moments, there were quarters where profits were perfectly fine, solid, healthy numbers, and the stock barely moved or dropped anyway. Same company, wildly different reactions. The profits weren't the variable. Something else was. That something is this. Stock prices don't track profits. They track expectations. Here's the number that explains it. According to decades of market research, over 70% of a stock's short-term price movement after earnings has nothing to do with whether the company made money. It depends entirely on whether the result was better or worse than what analysts predicted beforehand. 70%, not the profit itself. The gap between the profit and the forecast. So here's how it actually works. And once you see this, you can't unsee it. Every quarter, before a company reports its results, professional analysts spend weeks building financial models. They talk to suppliers, study competitors, analyze historical patterns. Eventually, they publish a number, their best estimate of what the company will earn. That number becomes the market's expectation. And the moment it's published, it gets priced into the stock. Investors buy or sell based on that forecast. The future result is already partially baked into today's price before a single dollar of profit has been counted. Then results day comes. Two things happen simultaneously. The company announces its actual profit, and the market instantly compares that profit against the expectation. Beat the expectation, even by a small amount, and the stock rises regardless of whether the raw profit number looks good or bad. Miss the expectation, even by a tiny margin, and the stock falls, regardless of how much money the company actually made. This is why a company can lose money and see its stock go up. The loss was smaller than feared. Relief is a form of beating expectations. It's also why a company can make billions and see its stock drop. The billions were less than hoped. Disappointment is a form of missing expectations. The stock market isn't a scoreboard showing how well a company did. It's a prediction market, constantly adjusting based on reality versus forecast. So what does this mean for you, sitting at home, watching your portfolio move in directions that seem to make no sense? It means the news you're reacting to is old news to the market. By the time a company's results hit your screen, institutional investors, the ones moving billions of dollars, have already repositioned based on their own forecasts. You're seeing the reaction to the reaction. It means profitable doesn't equal rising, and losing money doesn't equal falling. The only question the market is answering is, was this better or worse than we thought? And it means the single most dangerous thing a retail investor can do is trade on earnings announcements. Because you're not competing with other confused people. You're competing with analysts who've spent 3 months building models specifically to predict that number. Stock prices don't reward past performance. They reprice constantly around future expectations. A company can be genuinely thriving and still disappoint the market. A company can be genuinely struggling and still surprise it. Once you understand that, the market stops looking random. It starts looking like what it actually is. Millions of people constantly updating their predictions about the future, one data point at a time. That's not irrational. That's just how expectations work. If this changed how you see the market, hit subscribe. Next video: why recessions aren't always bad for your investments, and the counterintuitive reason some of the best buying opportunities in history happened during economic downturns.